One of the critical decisions entrepreneurs face when starting or scaling their business is whether to bootstrap or seek external funding. Each approach has its advantages and disadvantages, and the best choice depends on various factors, including the nature of the business, growth goals, and personal preferences. Here's a detailed comparison to help you decide which path is right for your business. Bootstrapping involves using personal savings, revenue generated by the business, or funds from family and friends to finance your company. This approach focuses on growing the business organically without relying on external investors. Advantages of bootstrapping: full control. Owners retain complete control over the business decisions and direction without the need to answer to investors. Equity retention. Founders do not need to give up any ownership stake in the business, which means they keep all future profits. Financial discipline. Limited resources often encourage more prudent financial management and resourcefulness, fostering a lean business model. Reduced pressure. Without external investors, there is less pressure to meet aggressive growth targets or achieve quick returns. Disadvantages of bootstrapping: limited resources. Growth may be slower due to limited financial resources, which can restrict marketing, hiring, and development opportunities. Personal financial risk. Founders bear all the financial risk, potentially putting personal assets at stake if the business fails. Scalability challenges. Bootstrapping may limit the ability to scale quickly, especially in capital-intensive industries or highly competitive markets. Opportunity cost. The time spent raising and managing personal funds could be used to focus on business development and growth strategies. Seeking funding involves raising capital from external sources such as venture capitalists, angel investors, banks, or crowdfunding platforms. This approach provides an influx of capital to accelerate growth and scale operations. Advantages of seeking funding: access to capital. Significant funds can be raised to support rapid growth, product development, and market expansion. Expertise and mentorship. Investors often bring valuable experience, industry connections, and strategic advice that can help guide the business. Shared risk. Financial risk is shared with investors, reducing the personal financial burden on the founders. Enhanced credibility. Securing funding from reputable investors can enhance the company's credibility and attract additional partners and customers. Disadvantages of seeking funding: dilution of ownership. Founders must give up a portion of their equity, which means sharing future profits and decision-making authority. Loss of control. Investors typically require some level of control or influence over business decisions, which can lead to conflicts or a shift in company vision. High expectations. Investors expect high returns, which can pressure the business to achieve rapid growth and profitability, sometimes at the expense of long-term stability. Time-consuming. Raising funds can be a lengthy and complex process, diverting attention from day-to-day operations and strategic planning. Key considerations for your decision: business stage. Early-stage startups might benefit more from bootstrapping to validate their business model before seeking funding. Established businesses with proven revenue streams might find it easier to attract investors. Industry and market capital-intensive industries, such as manufacturing and technology, may require external funding to cover high upfront costs. Conversely, service-based or digital businesses might scale effectively through bootstrapping. Growth goals. If your goal is rapid expansion and market domination, seeking funding may be necessary. If you prefer steady, controlled growth, bootstrapping might be more suitable. Risk tolerance. Consider your personal risk tolerance and financial situation. Bootstrapping involves more personal financial risk, while seeking funding spreads the risk, but requires relinquishing some control. Long-term vision. Reflect on your long-term vision for the company. Do you want to maintain full ownership and control, or are you open to sharing equity and collaborating with investors? Deciding between bootstrapping and seeking funding is a critical choice that depends on your business goals, industry, personal risk tolerance, and growth strategy. Both approaches have their merits and challenges, and the right path varies for each entrepreneur. carefully evaluate your business needs, market conditions, and personal preferences to make an informed decision that aligns with your vision for success.